growth or stability? $100,000 on the line and two ETFs battling it out. Which one comes out on top? All right, let's talk about your $100,000. First off, congrats. That's a big deal. But here's the thing. Letting it sit in a savings account, not the best move. Inflation's like this sneaky thief, quietly shrinking your money's value every year. So, what do? That's where ETFs come into play. And today, we're looking at two heavy hitters, QQQM and SCHD. Now, these aren't your average investments. One's all about tech-fueled growth, and the other's a steady income machine. The big question is, which one's right for you? In this video, we'll break it all down. No boring jargon, just the straight-up facts. By the end, you'll know exactly where your $100,000 could work harder and smarter. Chapter 1. What are QQQM and SCHD? Alright, so before we dive into the details, let's get clear on what these two ETFs actually are. First up, QQQM. This is like the younger sibling of the famous QQQ. It focuses on the NASDAQ 100, meaning it's packed with the biggest tech names out there. Think Apple, Nvidia, Amazon, companies that are shaping the future with innovation. It's all about growth and capturing those high-flying opportunities in tech. Now, SCHD is a totally different vibe. It's built for stability and income, focusing on solid, dividend-paying companies. We're talking blue-chip names like Cisco, Home Depot, and Pfizer. These are reliable businesses that pay you just for owning them. It's less flashy, but definitely dependable. Here's the key. QQQM is like the adrenaline junkie. High risk, high reward. While SCHD is more like the wise old friend who believes in slow, steady progress. Each has its own strengths, but they cater to very different goals. So whether you're chasing rapid growth or looking for stable income, these ETFs offer unique paths. Got a clearer picture now? Great, because we're just getting started. Chapter 2. Performance Comparison. Now let's get into the numbers. Because at the end of the day, performance speaks louder than anything else. Let's start with QQQM. Over the past year, it's delivered a jaw-dropping return of 32.13%. Pretty impressive, right? Zoom out to 10 years, and its growth rate sits at 77.65%. That's the power of tech-driven growth for you. But here's the thing. It's not all smooth sailing. Tech stocks can be volatile, so those big gains come with some ups and downs. On the other hand, SCHD is more about steady, predictable returns. Over the last year, it's posted a solid 17.96% return. And while that's not as flashy as QQQM, SCHD's consistency shines over the long haul, with a 10-year return of 114.28%. That's reliability you can count on, even when markets get shaky. The key difference here? QQQM thrives in bullish markets, riding the wave of tech innovation. SCHD, meanwhile, is the steady ship that holds strong during rough waters. It might not grow as fast, but it offers peace of mind when volatility strikes. So, which one's better? Well, that depends on your style. Do you want to chase big returns with QQQM, knowing there's some risk involved? Or would you rather enjoy the calmer, predictable ride with SCHD? It's all about what fits your goals. Chapter 3. Dividend Yield and Growth. Alright, let's talk dividends. This is where SCHD really stands out. It's like the gift that keeps on giving. Right now, SCHD has a dividend yield of 3.39%. What does that mean? For every $100,000 you invest, you're pocketing $3,390 annually before reinvesting. And here's the kicker. SCHD's dividends don't just stay the same. They've been growing at an average rate of 11.13% per year over the last decade. That's the magic of compounding. Those payouts snowball over time, adding even more to your returns. Now, QQQM plays in a different league. Its dividend yield is much smaller, at just 0.63%. So for that same $100,000 investment, you're getting $630 a year. Not exactly life-changing, but there's a twist. QQQM's dividend growth rate over 3 years is a whopping 23.62%. That's huge! The catch? It's starting from a much smaller base, so it'll take time before those payouts feel significant. So what does this mean for you? If you're someone who loves the idea of cash flow, whether to reinvest or live off, SCHD is the clear winner. But if your main focus is on long-term growth, and you're okay with smaller dividends for now, QQQM might still hold appeal. It really comes down to your priorities. Do you want steady income now, or are you willing to wait for potentially bigger rewards down the road? Either way, these ETFs approach dividends in 2 very different ways. Chapter 4. Sector Allocation and Holdings. Let's dig into what these ETFs actually hold, because where your money goes matters a lot. Starting with QQM, this ETF is heavily focused on tech. In fact, over 50% of its portfolio is in technology stocks. We're talking about giants like Apple, Nvidia, and Amazon. These companies are at the forefront of innovation, driving industries like AI, cloud computing, and electric vehicles. But here's the flip side. This concentration in tech makes QQM more vulnerable if the sector takes a hit. It's a high-reward but high-risk approach. Now, SCHD is a different story. It's built on balance. Its largest allocations are in financials, healthcare, and consumer defensive sectors, industries known for their resilience. Some of its top holdings include Cisco, Home Depot, and Pfizer. These companies might not be as flashy as tech giants, but they're dependable and deliver consistent dividends. Plus, SCHD spreads its risk better, with its top 10 holdings making up only about 40% of the portfolio compared to QQQM's 52%. So, what's the takeaway? If you're all in on tech and believe in its long-term growth, QQQM could be your pick. But if you value diversification and a smoother ride, SCHD's balanced approach might be more your speed. The choice depends on how much risk you're comfortable with. Chapter 5. Expense Ratios and Long-Term Cost. Alright, let's talk about something that doesn't always get the spotlight but can quietly eat into your returns. Expense ratios. These are the annual fees you pay to own an ETF, and over time, they add up. SCHD is the clear winner here, with an ultra-low expense ratio of just 0.06%. That means for every $10,000 invested, you're only paying $6 a year, basically pocket change. On the other hand, QQQM has a slightly higher expense ratio at 0.15%. For the same $10,000, you'd pay $15 annually. Still reasonable, but over decades, those extra costs can make a difference, especially for long-term investors. Here's the thing. Lower fees mean more of your money stays invested, compounding, and working for you. So if you're planning to hold for years, SCHD's cost advantage gives it a small but meaningful edge. It's not a deal breaker for QQM, but it's something to keep in mind when comparing the two. Chapter 6: 30-Year Growth Projections for $100,000. Now, let's get to the exciting part. What happens if you invest $100,000 in QQQM or SCHD and just let it grow for 30 years? The numbers here are pretty eye-opening. Starting with QQQM, it's all about growth. With an average annual share price appreciation of 16.06%, your $100,000 could balloon to a staggering $9.4 million. Most of this comes from capital appreciation, as the tech-heavy portfolio rides the wave of innovation. But here's the catch. Its dividend yield is only 0.63%. So after 30 years, you'd only see about $8,300 annually in dividend payouts. It's a high-risk, high-reward strategy that relies heavily on tech continuing to dominate. Now, SCHD takes a different approach. Its annual share price growth is a steadier 8.14%, but when you factor in its 3.39% dividend yield and 11.13% annual dividend growth, the compounding effect kicks in. After 30 years, your $100,000 could grow to $4.4 million. Even better, its dividends alone could provide an annual income of $36,000 by then. That's a stable cash flow you could actually live on. So, what's the bottom line? QQQM delivers jaw-dropping growth, but it's heavily reliant on the ups and downs of tech. SCHD grows slower, but it offers peace of mind and reliable income. It all comes down to what you prioritize: aggressive growth or long-term stability with consistent cash flow. Either way, both options show the incredible potential of ETFs over the long term. Chapter 7: Which one is best for you? Alright, so here is the million-dollar question. Which ETF should you pick? The truth is, there's no one-size-fits-all answer. It all depends on your goals, risk tolerance, and timeline. If you're someone who's all about chasing growth and doesn't mind a bumpy ride, QQQM might be the better fit. It's perfect for younger investors or anyone with a longer time horizon who can stomach the ups and downs of the tech sector. You're banking on big returns over time, and you're okay with smaller dividends now because capital appreciation is your main focus. On the flip side, if you value stability and like the idea of consistent cash flow, SCHD might be more your style. This ETF is ideal for those nearing retirement or anyone who prefers a predictable, steady investment. With its strong dividend payouts and lower volatility, it's like having a safety net while still growing your wealth. At the end of the day, it's not about which ETF is better. It's about what works best for you. Take a moment to think about your financial goals, your comfort with risk, and how long you're planning to invest. Once you've got that clarity, the decision becomes a lot easier. And that's it for this video. Thanks for watching, and we'll catch you in the next one.